Good morning. This is May Valensky with Driving Markets. Remember, driving while talking about markets. At the moment, I'm stationary, but I'm in the car. Anyhow, anything said in this piece is an opinion only, not financial advice, not investment advice. It's purely an opinion based on my experience, knowledge, and feel, technicals, etc., etc. Remember, I've also got 3 other media channels open, which are Instagram and TikTok. So obviously I do much shortened versions there of 90 seconds or maximum 3 minutes, depends on the actual media channel. So let's kick off. Wow. Okay. So firstly, apologies for I didn't do a video or a broadcast yesterday. It was just tied up. But let's see what's happening, what's driving markets today. Yesterday came out with this CPI, the Consumer Price Index. The Consumer Price Index, for any of you that know or don't know, is the main measure as far as retail price inflation is concerned in the US, and it was expected to come in lower, a little less, at 0.1% lower than the previous month, and it did come in exactly at 0.1% lower than the previous month. Now my opinion is that all the numbers are manufactured, because when they take the basket of goods, it's very much in favor of the Fed and the government to keep inflation down. But we all know that real inflation, the real cost of living, the real amount of money left in your pocket by the end of the shopping day or the end of the week is a lot less than it was a few months ago, and a lot less than it was a year ago. So we all know that the real inflation is much higher than the 5, 6 or 7% that they're claiming. So annual inflation in the US is coming in at 6.5%. Now that sent markets yesterday all over the place. We're going to focus this session on inflation, just to give you a bit broader knowledge and understand of what makes up the figures and what the impact it is on financial markets. So month on month it dropped 0.1% expected. Okay, year on year it's running at 6.5%, lower than it was already, or the lowest since been October 2021. Now, what's interesting is that looking at financial markets reaction, that they first of all shot up on the news, then they dropped significantly, then they shot up, and then they dropped. So the volatility was significant. It has high impact volatility on financial markets. So I want to just mention something specific here. My opinion is, and I strongly believe, that this is an opportunity to sell into the equity markets. They've run up far too high. The traders on Wall Street and Europe and the UK were looking for any excuse to push the markets higher in January, because January is known as the barometer month. And when it's the barometer, it's the measure of what happens in January, happens the rest of the year. So they're desperate to push the markets up higher in January in order that they will have a good barometer, a good measure that the year will finish on a high. 2023, they want to finish on a high. I'm of the opinion that now you need to sell into this rally. This is a fake rally. There is still far too many uncertainties for me to be convinced that this is now going into a bull market, everything's going to go up. Interestingly enough, Bitcoin went above $18,000 a coin for the first time since the FTX scandal in November. Remember that as rates come down, high risk assets like cryptos and like the Nasdaq and like the high-tech sector will move up. But again, I want to emphasize, I believe this is a massive bear rally. We are in a significant bear market, and we're going to go into recession this year in 2023, and that's going to push all markets down, going to push all equity prices down, and going to drive earnings down furthermore. There's going to be multiple layoffs, and you'll see unemployment rise. As unemployment rises, there'll be less money available amongst the consumer in order to maintain their purchases and therefore add to the profits of those companies that are listed in the financial markets, and even those that are not listed will be looking obviously for the consumer spending. So as far as inflation is concerned, even though we've seen a drop last week in wage inflation and a drop in the CPI yesterday of 0.1%, that is not sufficient to drive these markets higher. In other words, there's a great opportunity here to sell Bitcoin, sell the Dow, sell the equity markets, sell the high-tech sector, and maximize on a short position in order to ride it out. As you'll see in the first quarter, it's been the first 6 months of the year, the markets will drop. And I'm talking about a 25 to 30% drop minimum in financial markets. I know it's extreme, and all my colleagues in senior colleagues saying, what you're talking about is not going to happen. It might drop 3%, it might drop 5%. It's not. It's going to drop significantly, and it's going to be, by the end of 2023, we're going to be around about 25 or 30% lower, at least in equity markets. This is an opportunity to open a position and sell into these markets. Yesterday, Tesla, Amazon, Google, CRM all went up with the rise in the markets. Okay, so the high-tech sector went up. We've mentioned Bitcoin, cryptocurrencies. The dollar went down against the majors, against the pound, the euro, and the yen. Because why? As equity markets rise, which are considered risk assets, so there was an appetite to get back into those risk assets. Then what happens is the low risk assets like the US dollar is sold off, and the higher risk assets like the pound, the euro, and the yen are deemed as higher risk. Then they are bought in on the foreign exchange markets. Interestingly enough, the US Treasury bond dropped all the way to 3.45%, and that would indicate also, because the bond market is the real indicator in financial markets. Now, the bond market indicates that the Fed in the US will lay off and take its foot off the gas on rising interest rates. Probably will do in January, but throughout the first quarter and by mid-July, we are going to see interest rates in the US at 7%, 6.5%, 6.75, 7.25, that number, not exactly at 7%. So someone said to me, they said, why do you give an exact number? Because when I give a number, I mean round about that number. So, if it doesn't reach exactly that number, they say, oh, you got it wrong. Remember, everything here is just an opinion. So I'm expecting rates to go up by July in the US to about 7%, and I'm expecting inflation to start climbing back up there again, back to the 7.5% by January, February time. Okay, I don't expect it to drop much further, and the Fed will have to go continuing raising rates in the US as we go on. That's more or less it. Now you can follow me on Instagram, you can follow me on TikTok. I might send out some TikToks on the group, etc., etc. You can comment. I'd love to get some feedback. We need to get some more viewings. We need to get more subscribers on this channel. We want to get this channel out as much as possible. Remember, this is a standalone opinion. It's not edited. It's raw material. I don't start doing all types of trappings and makeups and one thing and another. What you see is what you get. Mayor Valensky, Driving Markets. Have a lovely weekend. Have a good Shabbos. Speak to you soon. All the best.